Hello everyone, and welcome to another JobKeeper presentation. I'm Alexis Kokinos, tax partner of the tax consulting division, and I will be presenting to you today on the alternative decline in turnover tests that were released by the ATO yesterday. And I'll just note that obviously the information that we're presenting on today is very, very new, only came out mid-afternoon yesterday. There's very limited examples in the documentation provided by the ATO. So we will be making a number of comments today during this presentation where there are some uncertainties, and we will be making some assumptions of what we believe the rules are saying. Obviously, the ATO may take a very different view. We have already put forward at least 10 questions to the ATO that we're looking for them to address. So please just bear in mind that this is very new information. You do need to keep up to date with the information. You do need to keep checking in on the ATO websites or checking in with your advisor to make sure you're getting the current information and the current views on any of the JobKeeper rules. While I go through this, what I think I might just quickly do before talking about alternative tests, I just want to recap very, very briefly about the JobKeeper regime and just give some perspective of today's presentation. So this is our third presentation in a series of presentations we've done on JobKeeper, and the first and the second were around what we call the basic test of the regime. So I believe everyone on right now would be fairly familiar now with the JobKeeper regime and what it is doing in terms of providing eligible employers that suffer a decline in turnover over a period, a payment of $1,500 per fortnight per eligible employee as a subsidy to keep paying their employees of their practice. In order to get into those rules, we have previously presented on determining whether you have suffered a decline in turnover test, which, although not required to be linked to COVID-19, has been done on a basis that if you suffer a sufficient decline in turnover during a requisite period as compared to the prior year, you can get access to the subsidy, presuming you meet all other threshold requirements. And generally, the thresholds have been $1 billion for a 30% decline. If you're greater than $1 billion, you need a 50% decline, and if you're a charity, you need a 15% decline, which doesn't include certain schools or education facilities. Now, the main thing with the basic test is it was very specific in terms of what you were testing. So when you looked at a fortnight, you looked at that fortnight, you looked at the relevant months that fortnight fell into, you looked at the quarter that it fell into, and you compared it to the prior year. And then you looked at the GST turnover of that prior year and the current period, and you did a comparison, and you needed to fall by the requisite threshold. It was a very stringent test, not much flexibility around that. You're comparing two periods together. Now, for a number of entities, that generally may have worked out okay, and they may have found that they have suffered a decline in turnover over the requisite threshold and are able to move on with their JobKeeper claims, which is coming up for this 30 April. However, there are a number of scenarios, however, where when you perform the calculation, you may get a result that is anomalous due to things that have happened during the year. This example just demonstrates that, and I'm sure that for all the attendees, you've probably gone through your circumstances and worked out that some of the scenarios may not be working properly for you in your calculations. So an example here we have, excuse me, is Bizco, who carries on a business, has 100 staff members, and in September 2019, it acquired another business, and the acquisition was so large that its sales income increased by 200% in September 19. So looking at the JobKeeper regime, and it's looking at the, just say, first fortnight, which ended on the 16th of April, it may have had a look at what its April turnover was. And as can be seen in this slide, its April turnover may be may have declined, so April 2020 may have declined to 2.5 million as compared to March 2020. But when you compare it to the prior year of 2019, it might be exactly the same as that amount. So the acquisition that happened in September may have boosted sales so dramatically that if we did a comparison of April 2020 to April 2019, the entity hasn't suffered a decline in turnover of 30%. There's actually no turnover decline that's happened. But when you compare it to the prior month of March 2020, you'll see there that there is a 59% decline in turnover that has been COVID related. So this is obviously an example of when the basic test may not be appropriate. So it was foreshadowed when the rules came out that the Commissioner would have a power to provide alternative tests to classes of taxpayers to deal with the test where the comparable period was not appropriate. The rule was contained in section 8.6 of the JobKeeper rules, and it said that the Commissioner may determine that an alternative decline in turnover test applies to a class of entities if the Commissioner is satisfied that there is not an appropriate relevant comparison period for the purpose of an entity in that class of entities satisfying the basic decline in turnover. Now, what it effectively allows the Commissioner to do is, by legislative instrument, determine those classes and determine an alternative test for that class of persons. And today we're going to go through what the Commissioner has come out with on that. Now, in consultation, we expressed a view that this represented a very wide power for the Commissioner to determine any alternative test for a class of entities. So we read that as being a very broad power. We were hopeful that it would cover things such as employment and service entities. We were hopeful it would cover finance entities that make input tax supplies. Unfortunately, as you will see, the legislative instrument does not cover either of those two scenarios. So just from a procedural perspective, the ATO did consult with a small group of people last weekend, and last Friday night we received a draft of the legislative instrument. We had until Sunday to provide comments to the ATO on the examples they provided. We did test some of the theories about their breadth of power, etc. And we put a very detailed submission back to the ATO. Now, it is pleasing to see the ATO did seek to address almost all of the issues that we raised. However, I'll state that this has moved and is continuing to move so fast that, as we'll highlight during this session, not all of the issues have been picked up and further issues have been created in the drafting. So you will not always get appropriate results in applying this legislative instrument. So under section 8.6 of the rules, the Commissioner now has issued legislative instrument 2020 SMB 0021, and it's called the Coronavirus Economic Response Package Payments and Benefits Alternative Decline in Turnover Test Rules 2020. So it's a bit of a mouthful. This legislative instrument contains 7 alternative decline turnover tests that can be applied to certain classes of entities. Just as a starting point, we note that at paragraph 2 of that legislative instrument, it states that the instrument commences the day after it's registered on the Federal Register of Legislation, which is essentially today, the 24th of April. We do have a bit of a concern in terms of the explanatory statement does say it has an application date of today. And one of the issues of the rules is that you need to meet all conditions at the end of every fortnight, and one of the first fortnights was on the 16th of April. Now, we don't expect the ATO to say you can't apply these alternative tests to the prior periods. However, we have sought clarification from the ATO on that date of application statement in the legislative instrument. Hopefully, on Monday, I'm doing a joint presentation, or I'm looking to do a presentation with the ATO. Hopefully, I'll be seeking some clarity by Monday on that item. Okay, so just recapping, we expressed a strong view during the consultation that the Commissioner had a very broad power. However, what has come through clearly in the explanatory statement is the Commissioner feels very constrained in respect of his power. So the Commission has taken a view that as a result of the requirements in that power, he can only determine an alternative test where there is an event or circumstance, being internal or external to an entity, that is outside the usual business settings of the entity of that class. Furthermore, the Commissioner has taken the view that his power is restricted to providing an alternative test in the same light as the basic test. So, i.e., you can only prove yourself capable of having a decline turnover if you meet the 30% rule. However, he'll allow you to compare different amounts in different periods. So he's taken a very restrictive view of what an alternative test may otherwise be. What this means is that the Commissioner has come out effectively and said he cannot deal with the finance entity issue that might only make input tax suppliers, because he doesn't have the power to change the test from taxable suppliers to input tax. He hasn't commented on this in the document, but we also understand that he feels the same about employment service entities, and that he doesn't have the power to deal with those entities as well, because they have a comparable period, and he doesn't believe he can adjust the rules that apply to them. So we may see something further come out from Treasury on the employment entity issue, on the financial entity issue, as well as some more guidance from the ATO on that. We have a legislative instrument that was released yesterday. It comes into effect today, and it contains 7 tests. Generally speaking, those tests can be applied in circumstances where you have commenced business in the last 12-month period, generally. There was an acquisition or disposal of a business. There was a restructure of the business. There was a substantial change in turnover during the periods. There was some irregular turnover during the periods. There's a special test for sole traders or small partnerships. And there's a special rule for those entities that have suffered drought or have been impacted on certain natural disasters. I just also will highlight, even though I won't cover the 6th and 7th one in too much detail in this presentation, I will highlight that almost every test has a specific additional modification for where you have suffered a drought, or you have been affected by certain natural disasters. So when applying those tests, they generally can apply to ignore those periods where you have had some effect due to those conditions. So if you have been impacted, please look at all the tests very carefully, because they have tried to be concessionary for those who have been impacted by those certain events. So the very first and critically important rule here is, are these alternatives to the basic test, and can they supplant the basic test? So if you've already satisfied a 30% decline and you apply a basic test and it gives you the completely opposite result, does that mean that this can override your answer? So the ATO have been very clear about this in their guidance. They're saying no, these alternative tests do not override the basic test. So if you are already through under the basic test already, you do not need to look at the alternative test. If you are uncomfortable with your basic test, you're sitting on 31%, then yes, you may apply an alternative test to see if you are well in excess of a 30% decline, and therefore get more comfort by applying an alternative test. But they are only in addition to that. You can apply as many of these tests as you would like. If you fall into 3 of them, you may apply all 3. And you can pick and choose as long as you meet the conditions to apply the test as an alternative test. Now, I will make a statement now that these are complex tests. Each one of these are very complex, and we do have a limited time to go through the tests. This session is being recorded, so please feel free to watch this session afterwards to go back over some of the calculations, some of the tests that we're talking about, in case I skim through it too quickly, or if you can't follow some of the numbers that we are talking about. So on each of the tests, I will go through a practical example to demonstrate how the test, the alternative test, will apply. However, because they can be quite complex, please refresh yourself once this session has been finished. Okay, so the very first alternative test covers a scenario where an entity commenced business before the 1st of March 2020, but after the relevant comparison period. So if we have a look at that, you might be testing the month of April to look at if there's a decline in turnover. So the comparison period would be, well, one of those could be April 2019. So in this test, your business must have started after April 2019, but before the 1st of March 2020. Now, as we move down this regime, that will continue to move as well in terms of the comparison period moves up. So it will go to May and then June, etc. So you need to keep working out whether you're in this test or not. This is one of the more concessional alternatives because the Commissioner has given 2 alternative tests to satisfy your decline in turnover. So test number 1, what he does is he'll say, look at your projected GST turnover for the period you're looking at and compare it to an average of turnover. Now, if you commenced the business in February, what you would do here is look at your February turnover. You would multiply it by 29, divide it by the number of days you're in business, and that will give you a true up amount for the month of February. That becomes your comparison dollar figure, and every month thereafter will be compared to that figure. If you didn't commence in February, then what you would do is you'd look at the average of GST turnover for the whole month after you commenced and up to the whole month prior to 1 March, so up to February 2020. And if you do this on if you're doing a quarterly comparison, so you're looking at the June quarter, comparing it to a quarterly comparison, you would just take that result and multiply by 3. So this is the first alternative test. If you don't get if you're a startup and you don't get in under that test, you can apply a second test. And under the second one, you would look at your, again, projected GST turnover, and you would then look at the 3 months, what they call the 3 months current GST turnover. And that's what you compare it to. And that is defined as the 3 months immediately prior to 1 March. So they say the quarter, December, January, and February. That becomes your comparison period for the startup. If you're doing a monthly test, you divide that by 3. If you're doing a quarterly test, you take that figure. So that's a lot of rules there to work through. So what will be good to do is work through an example of this. So in this example, BizCo commenced business on the 15th of October and assume during April, BizCo was doing the test, was trying to do the test to work out if they've had a decline in turnover. So they go through their numbers and they start with their testing under the alternative position. Now, obviously, we can't go to doing the basic test in this case because there is no comparison for April, May, or June, or a June quarter, so the basic test does not work in this case. So if we're looking at test number 1, what do we need to do? So test number 1 said, let's look at because we've started prior to February, it says, let's look at the average of all the months, starting from the month after you commence, i.e. November, and finishing on the month before March, so finishing in February. Now I'll take that result, which is, as you can see in the table, 2.9 million. That's the total of those 4 months. And because there's 4 months, we would take an average. It would give you 0.73 million as the average of those 4 months. That becomes your comparison amount. Now in April, we estimated turnover to be 55 million. So if I compared 55 million to 73, I've only suffered a 24.66 decline in turnover. So under the first test, I would not satisfy a 30% decline in turnover. I would not get into the JobKeeper rules. Now, if I look at the second test, in that one, I'm allowed to pick the 3 months before March. So I look at December, January, and February. and that gives me 2.7 million. But it's over 3 months, so an average per month is 0.9 million or 900,000. In this case, when I look at the decline in turnover, I've had a 38.89% decline when I look at the 0.55 mil or 550,000 as compared to the 900,000. So when I compare April to the average of that quarter, I've had a 38.89% decline. And under the second alternative test, I would be entitled to the JobKeeper payment subsidy. So that's basically how this alternative test applies if you commence business. Now, there are a number of things that come out of this in terms of issues or watch-outs that we just want to alert you to. The first is that the explanatory statement the HO released clearly states that this only applies to entities that were not operating any business. So it can't apply to an entity that was operating one or more businesses and commenced to add another business to its existing business. Where you've got that type of case, there are other turnover tests that can apply to that. So you can't apply this commence business test. So the second item here is that you need to commence your business after the relevant comparison period. So the test can only apply if you commenced after that relevant comparison period. So if you commenced in June 2019, this means you could use this test for both a comparison period of April and May, but you can't use this if you're doing a June quarter assessment. So if you're doing a June quarter assessment, obviously when we look at the comparative period, i.e. June quarter 2019, your business did not commence in that example after June 2019. So there will be a certain time where businesses that have commenced, if they commenced prior to September, there will be a time where this test will no longer be available for them. Now, the reasoning for that is because once we move down months and you have a period that you can compare to in the prior year, the HO's view is you do therefore have a comparison period and you can start using the basic test. Now, we would argue that that's not correct because you would have started up during that period, so your sales were probably a lot lower than what they would otherwise be once you've started up. However, that's effectively what we have at the moment. Finally, I've just got to highlight that if you're looking at the ATO's explanatory statement, you do need to be careful. The instrument that I've just gone through clearly states that the 3 months you test for the second alternative test is December, January, and February in all cases. However, the ATO's explanatory document that accompanied this said used a different 3-month period. It says effectively use 3 months prior to the testing period. So if you're testing in June 2020, the explanatory statement said use the 3 months before that period, which will be May, April, and March. So please be careful. We believe the explanatory statement has incorrect examples and incorrect periods. The second scenario deals with a situation where there has been an acquisition or a disposal after the relevant 2019 comparison period, but before the test period. So what this is trying to deal with is a situation where you've bought a business after the period that you're comparing to, and because you've bought that business, it has increased the amount of your turnover such that the current period might be overinflated by that new business. So it's looking to make an adjustment to the values so that you don't have a detriment due to that acquisition. So the alternative test that is provided in this case is it looks at the period. So if we're looking at April and we're doing a test period April 2020, we're looking at a test period April 2019. Rather than comparing to April 2019, this lets you look at the whole month immediately after the acquisition. So if we had an acquisition in September 2019, we can now use October 2019 as a comparison month instead. If you're instead doing a quarterly comparison, you would get that month and you would multiply it by 3. Now they have a special rule that deals with multiple acquisitions. So you might have bought 3 or 4 businesses. So you look at the very last acquisition and you take the turnover in the month following that last acquisition. Now it has a very, very funny rule at the end that says if that last acquisition effectively butts up to your testing period, then you take the month before. Now, I'll highlight some anomalies in that test after I go through an example. So in this example, we're going to look at Bizco, who carries on a business and acquired another business in October 2019. So as a starting point, you will see there that they had April 2019 sales or turnover of 1 million, and they've estimated their final April 2020 turnover to be 0.9 million. So there's only a 10% decline. They do not get into the basic test. Now, obviously what we're saying here is that that 2020 figure may have been impacted by the acquisition, so it might be overinflated. So under this test, what I'm allowed to look at is the month post-acquisition. So that would be November, and the turnover in November is 1.3 million. So that can now be my comparison period. So I'm allowed to compare April, which is 0.9, against November, which is 1.3. As you can see, if I look at that on a monthly basis, I will get a 30.77 decline. But I'm also allowed, if I'm doing a quarterly comparison, I'm allowed to multiply that by 3, which takes me to 3.9 million. And I'm allowed to take my June quarter estimate and compare it to that figure too. And as you can see, it's 2 million divided by 3.9, which gives me a decline of 48.72. So this alternative comparison, which is comparing to the November, which is after the acquisition, is giving me a much larger decline in turnover, which allows me to get access again to the JobKeeper provisions under the alternative test. Now, again, there's a couple of watch-outs or just some things we'd just like to highlight if you are going to apply the acquisition and disposal rule. The first is, as can be seen in the example, November was the relevant reference period. If there was only one acquisition. So that is the period for all testing. We won't move from November. That becomes the base period. You will do all your testing to that period. So just keep in mind, you don't need to do anything further in terms of other months under this alternative test. So the second question we've got here is, what if an acquisition occurs in April and it's the only acquisition? Now, we think there's a bit of a drafting error in this one. So under the Rule 7, it's sub 4, what they've done is they've created a special rule to deal with sequential acquisitions. And if there's a sequential acquisition and there isn't a month in between that acquisition and test period, they let you look at the month before. But unfortunately, it refers to it only applying in sequential acquisitions. So if you're going through a transaction right now and you buy a business in April, just say, so there's an acquisition in April and you are testing this test in May, we would go to the basic rule, and because there's no sequential acquisition, you would test the period after the acquisition. So you would effectively be testing a period with May in this example. Now this can create a bit of an anomalous outcome because you may not be able to satisfy the rule in such a case. We don't believe that was intended. We do believe that it should have had the same rule as what occurs for sequential acquisitions in this case. So we have raised this with the ATO, but we are just saying be careful if you do have acquisitions in any period of March and onwards and you're looking to apply this test. The test only also applies if you acquire or dispose part of your business. So if you get a blank company and buy a whole business, then this test cannot apply. It can't apply to a full whole business acquisition. You do need to carry on some business beforehand. Now, noting that though, please remember, we just went through the commenced business rule, and yes, you might have acquired a business and commenced business at the same time, so you might get access to other rules in such a circumstance. We also highlight that there is a special interaction for the basic test if you are doing acquisitions. So just keep in mind, some people might also get a favourable outcome under the basic test when they have sold a business. So for GST turnover purposes, if you sold a business, just say last April, and it was a capital sale, then it can be excluded from current GST it may be included in current GST turnover and may inflate what your turnover is last year. If you're selling a business now under Section 188-25 of the GST Act, that there's an exclusion from projected turnover. So your April 2020 figures may exclude potentially that sale, which may give you a favourable outcome by not including those. So just be mindful, there are some interactions with transactions for the basic test. The only other thing I'd highlight here is that it talks about acquisitions and disposals. And now my first or earlier comment was this can't supplant the basic test. So if you had a disposal, you'd expect that would have reduced your sales. And so therefore you should get, it would potentially give you a worse outcome by reducing the amount of sales that that business is otherwise doing in the comparison period. Now, again, because it can't supplant your basic test, you don't need to apply it. Secondly, we believe it's just there for the sequential acquisitions and disposals. You might have a large acquisition and divest part of the business. It will effectively take the net result after the last of those transactions. Okay, so the third scenario is very, very similar to the last one. This scenario deals with restructures. So essentially, if your business has restructured after the relevant 2019 comparison period, but before the period that you are testing, then you can get access to this rule. Now, the restructure has to have changed your turnover to be in this rule. So this test is drafted almost identically to the acquisition one that we just went through. It's got exactly the same. The gateway test just refers to though a restructure that's occurred. And the alternative test is again exactly the same as the acquisition rule. It looks at the whole month immediately after the restructure. And if you're doing a quarterly comparison, it multiplies it by 3 and has exactly the same sequential events rules in there as well. So essentially they go hand in hand. What they're trying to do is if you acquire a part of a business or you're restructuring your business, essentially you'll be looking at this rule that covers those types of scenarios. The obvious question will be, what is a restructure? What can a restructure cover? The HO have taken a very broad view as to what a restructure can be in a draft determination TD 2019 D1. They do mention that it does take its ordinary business meaning and can look at almost all reorganisations of a business. However, again, you would need to look at the facts and circumstances in your case. For example, if you acquired a single contract, would that be a restructure? Versus moving a significant amount of plant and equipment from one business to another, would that constitute a restructure? So it's obviously critical for you to look at your facts and circumstances, but remember again that you should be looking at this in line of the acquisition or disposal one. So if something is not enough to mean that it's an acquisition of a business, it may mean that you have effectively restructured your business. So these two should always be looked at together. So an example just to demonstrate this one, it's effectively the exact same example we just went through. So I'm not going to go through this one in detail. The only difference here is BizCo entered into a restructure and moved its production and warehouse functions to a third entity, MergeCo, in October 2019. So that's the only difference. Everything else in this example is exactly the same. You'll see there that we don't satisfy the decline of turnover under the basic test, which was only 10%. But if I pick up the turnover after the restructure, which is in November, I get either 30.77% or I get 48.72%, depending on whether I'm using a month or quarter. So these figures haven't changed from the last example because the testing is exactly the same. So additional watch-outs, I'll refer back to exactly the same watch-outs we talked about in the acquisition disposal section, because this is drafted in the same manner. So all those issues about timing and sequential acquisitions are all relevant for this rule as well. What happens if you merge into a brand new company? I think I've already touched on this. If you merge into a new company, there's going to be a real question as to whether an entity has restructured its own business. So it talks about restructuring your own business. And if you didn't have a business prior to that, can you really restructure your own business by that acquisition? Again, this does not preclude you from applying the new business test. So you need to work out which is the relevant and practical test for your circumstances. And you do need to make sure that you are in the rule to apply the rule. So what happens if a restructure spans multiple months? So you start a restructure in May 2019 and it takes a few months and you finish it in July 2019. We believe that what happens, which is consistent with the explanatory statement, is you look at the whole month after the restructure. So in that case, you would look at August 2019, and then you would pick up the turnover in that period as the comparison period. That makes sense because after you've implemented the restructure, it is your turnover after that restructure that you're interested in. Okay, so the next alternative test. This alternative test is called the substantial change in turnover test. And essentially what it's trying to do is look at a business that has undergone extreme revenue growth over the last effectively 12 months. And it acknowledges that if you've been a growth business, comparing yourself right to the start of that period may not be appropriate because you've grown by so much. So it looks to make some adjustments in that kind of situation. So it gives you three gateways into this test. Essentially, it says if you've had an increase in turnover of 50% or more over a 12-month period immediately before the applicable turnover test period, so the period you're in, if your turnover is increased by 25% or more in the 6 months immediately before the test period, you could be in. And if your turnover is increased by 12.5% or more for a 3-month period immediately before the applicable turnover test period, you could be into. So looking at growth of 50% over 12 months, 25% over 6 months, and 12.5% over 3 months, then you can get into this alternative test. So what does the alternative test do? It uses a concept called a 3 months current GST turnover. And that's essentially the turnover for the 3 months immediately before the applicable test period or turnover test period that you're looking at. So if you're looking at April and you're looking at doing a test for April, you would look at the 3 months prior to that. March, February, January would be the 3 months. If you're doing a monthly test, you would take those 3 months and you would take an average of that. So divide it by 3. If you're doing a quarterly test, you would use that figure and you would compare to that figure. So this becomes essentially a test where it's looking at your more recent turnover rather than going back and comparing to 12 months ago. Now, I will state that there is some ambiguity in the reading of this test in terms of what exactly are you testing in terms of that period. When it talks about the 12 months, what do they mean exactly by 12 months? Are they saying you need to work out your turnover for 12 months to 30 March 2020 and compare it to 12 months of March 2019, or are they saying look at the month of March, compare it to March 2019, and see whether you've grown by 50% over that period? Now, the reason it's a bit ambiguous, it talks about that you had an increase of 50% or more in the 12 months rather than over the 12 months. So it talks about inside the 12 months. We think that the test is intended to look at the month of March 2019, for example, as compared to the month of March 2020, and if that's grown by more than 50%, you should hopefully be in this test. We have asked the HO this question to clarify. They do not have an example on this at all in the explanatory statement. There is no further commentary on this, so this is not clear at all. It is ambiguous. The second thing I've got here is does the testing period make sense when testing months after April or quarters after June? So for example, we just say we're testing July 2020, and what this test will do is look at the 3 months before July. So you're going to be looking at June, May, and April. Now, obviously, those 3 months would all have been affected by COVID, and you're supposed to take an average of those 3 months and use that as your comparison to July. So the question is that the right 3 months to use as a comparison period to test the effect of COVID-19? And I don't believe it is. However, and so this may not be as appropriate once we start moving to months after April or quarters after June. So just be aware of that. You might start to get some strange outcomes once you finish testing April using this method. Okay, so an example to demonstrate this alternative test. So we've got Bizco. They've won a contract in February 2020, just before all of COVID started to happen. And this had a substantially large increase in turnover as compared to the prior year. So they've gone to test the prior year and there's no way they'll satisfy it. Looking at the table there, you'll see February, the sales after this contract was entered into, sales are 1.4 million in February. And if you look at the prior year, it was 0.7, so it's doubled our turnover. So we're now doing a basic test in April, just on the basic test, and we're looking at April's turnover in 2020, which is 0.9, compared to the prior year, which is 1 million, we only declined by 10%. But effectively, that new contract has overinflated our April sales, and so isn't providing us the right result. So now we look at the alternative test here. So we're allowed to pick up the 3-month period prior to April, which is January, February, March, and that equals 3.9 million. And we can divide that by 3, and that will give us 1.3 million. The 1.3 million now becomes the comparison. Now, sorry, I will jump back a step. The thing that I did fail to mention was that we had to have a 50% increase in turnover over a 12-month period to get into this test. As you can see there, in the 12-month period prior to April, which was March, there was an increase of the March turnover from 0.9 to 1.6, which represented a 77.78. So apologies, I failed to mention that the turnover due to the contract had increased by more than 50%. So there had been a substantial change in turnover during that 12-month period to get into this. So coming back to the actual change or the alternative test, as mentioned, that allowed me to now pick up the 3-month period prior to April. So that was a 3.9 million divided by 3 to give me 1.3 million as my now new comparison value to compare April to. So I'm comparing now April's results of 0.9 million to the new figure of 1.3, being the average of the 3 months prior. And that gives me a 30.76% decline in turnover. So under this alternative test, I will get into an appropriate decline in turnover and possibly into the JobKeeper rules as well. Now, just before I go through the next one, as you can see from that last example, the critical thing there is that for any number of reasons, a person may fall into the substantial change in turnover test and may also get a result like this. It is quite important for people who are failing the basic test out of prudence to work their way through this alternative test to see if they meet the gateway. Remember, the gateway was looking at a 12-month period, a 6-month period, and a 3-month period with different increases of turnover during those periods. So it is important to determine whether this test can otherwise apply to you if you're not otherwise in the basic test. So the next test, which is similar, is what we call the irregular turnover test. Now, when you go through this one, it seems a bit strange at the start, but what it's trying to do is look at whether there was an irregularity in your turnover over the last 12-month period that has thrown off your calculations. Now, it's not looking at any cyclical changes, and it specifically excludes those businesses that have cyclical change. So if you are a farm or you are another type of business that has ongoing cyclical events, high season, low seasons, you cannot use this rule. It's looking at something that has occurred where you have had an irregular amount of turnover. So it could be a new contract that has been won. It could be an industrial dispute. It could be anything that may have had an irregular effect on your turnover. What it requires you to do is look at all the quarters in the prior 12 months to your test period. And you would look at each quarter and look at the lowest quarter, compare it to the highest quarter. And if the lowest quarter is no more than 50% of the highest quarter, then you can get through into this gateway test. So if you get through in the gateway test, it gives you the alternative test, which is you look at a different comparison period. So if your comparison period is a month, you will use the average monthly current GST turnover. If the comparison period is a quarter, then they would take that, that figure and they would multiply it by 3. So it will look at the average monthly current GST turnover, which is effectively the average turnover for that 12-month immediately prior period. So let's have a look at an example here and how that works. So again, Bizco had an industrial dispute, affected its turnover in April 2019. The lowest quarter in the last 12 months is 50% of the highest quarter. So let's have a look at the numbers here. Under the table, you'll see April 2020 sales were $25, April 2019 sales are $30. Now, April 2020 has been affected by COVID, that's why it was down. April 2019 was affected by the industrial dispute, that's why it was down. So to get in this rule, they say pick out your lowest quarter. Our lowest quarter here is the June quarter. It has $90 worth of sales or turnover. And it says pick out your highest quarter, which is December 19, and that has $195 of turnover. And you do a comparison of the two. The lowest quarter here is 46.15% of the highest quarter. So essentially, because that's not greater than 50%, we do meet the irregular test, which means we can apply this test. It then allows us to look at the average amount over the 12-month period to March 2020, and that gives me a figure of $53 being the average amount for that 12-month period. It then allows me to compare my April 2020 figure of $25 to the $53, and that represents a decline in turnover of 52.83%. So under this test, due to the irregularity, we could get through the 30% decline in turnover test and get into the JobKeeper regime. So again, this is very similar to the prior test. In terms of entities will probably not know whether they're in this test unless they go through a calculation. They determine whether they can get through the threshold, and then they work through what that otherwise means from an average perspective to work out whether they might meet a decline in turnover test. So there's a lot more in terms of calculations that need to be performed here, but again, it could result in the relevant entity meeting the decline in turnover. So just a couple of watch-outs or quick items to cover here. So the first one is, does the irregular period need to be the comparison period? Our reading of the provision is no, it shouldn't. We believe it can be applied if you have an irregular period anytime during that 12-month period. You just need to pick a quarter, make sure that a quarter is less than 50% of the high quarter during that last 12-month period, and that will allow you to take the average and use that as a comparison. Remember, again, it can't be cyclical. The second question here is, can this test be applied to a startup? So just say you started in a period such as August. Can you still apply this test? On the words, potentially you may be able to get access to this. You still could work out what your quarter totals would be, and for those quarters you didn't exist, it would probably be 0, and you may be able to get to an average for all of those periods and apply that. We do not believe this provision was intended to apply to startups. But it possibly, on the reading of the words, may be applicable. The HO may come out with further guidance on whether a startup may apply this test if they don't otherwise meet the business startup rule. So those are the core tests that are contained in the package, the core alternative tests. There are a couple of other tests that I'm not going to go through in any detail, but I'm going to mention. In terms of, there are some alternative tests for 3 other classes. The first is a class called the sole trader class. They need to be a sole trader that has no employees, and their turnover has to have been affected due to the individual, the sole trader, being unable to work during all or part of the relevant comparison period due to sickness, injury, or leave. The partnership example is a small partnership. It's exactly the same, effectively. It talks about that partnership having no employees, and again, the turnover has to be affected due to one of the partners being unable to work for the same reasons. So in that case, they do give you an alternative period. You look at the period just immediately after that period the person returned to work to use that as a comparable period. So there's an alternative test there. For droughts or natural disasters, if the entity conducted business in a declared drought or other natural disaster zone area during that period, and the drought or natural disaster changed entity's turnover, you may get access to this other concessionary rule. Essentially what this one does, rather than look at last year's values, you can look at the prior year's values. So you can look at 2018 instead. As I mentioned earlier, if you are one of those taxpayers, there's also adjustments to each one of the other 5 tests that we just went through that might give you some concessionary periods where you might exclude those periods that you were otherwise affected. Okay, so that brings us to the end of the presentation. And there's a few takeaways from this that I just want to reiterate. The first is that I've just gone through 5 main tests and a couple of subsidiary tests, covering a number of different scenarios. You may be able to apply more than one scenario. You might have a business that commenced, that then acquires a business that merges with another business, and you may have therefore 3 of the tests. And accordingly, you can trial them all to see whether you get an appropriate decline in turnover under any of those alternative tests. I will highlight that, as you can see, there's a substantial number of alternative calculations that you need to make under all of those alternatives. So if you're looking to apply the alternatives, you need to start acting straight away, because there is a lot of work to go through to work through all those and make sure that you are applying them correctly. As you all will realise, there's a limited time for entities to assess their compliance here. The deadline is 30 April to make an assessment. There are some extensions around certain things. However, payment deadlines, enrolment deadlines, etc. at the moment, we still do have this 30 April deadline for a number of the entities for JobKeeper. So it can require a lot of things to be done between now and next Thursday when that cutoff comes. So I hope that this presentation has provided you with a lot of information around these new alternative tests. Please feel free to contact your Pitcher Partners representative to go through these alternative tests to see how it may otherwise impact on your business. Again, I would stress you should need to be acting as soon as possible if you're looking at the 30 April deadline. I wish you all the best of luck going through all these, and thank you very much for attending this presentation.